All right, so good afternoon, and welcome to the class that teaches IAS 8. IAS 8. Now, IAS 8 is about accounting policies, changing accounting estimates, so it's a very long one, eh? Accounting estimates and errors. So it's three things combined in one, and that is what we'll be looking at. All right. So that is basically it. Now, I have actually reckoned that this is the most dangerous standards in all the accounting standards. This is the most dangerous one because it gives some freedom of operation. Because when you talk of accounting policies, so let's pick them one by one. When we talk about accounting policies, in terms of policies, what do we mean by that? Because it kind of talks about the specific principles, the basis, the rules, the practices, what you call it, the conventions, whatever you call it, that is applied in the preparation of financial statement. So here we have standards, you have your principles. So it gives you room for you to apply your principles to certain aspects or certain items in the financial statement. That is why it's the most dangerous one because it leaves room for subjectivity. Don't forget, from conceptual framework, we learned that we are using principle-based, not rule-based. All right, so in principle-based, there is little room for maneuver. So in terms of accounting policies, what you are looking at is we are looking at the specific principles, all right? So we are looking at the specific principles. Specific principles, you can say the basis, you can say the rules, you can say the conventions, you can say the practices, all right, the practices, all these, all right, that are applied by an entity in the preparation and presentation of financial statement. All right, so we are giving some liberty, okay, because come on, if you are preparing financial statements, some things like your inventory, how do you measure your inventory? Because there's no one way to measure an inventory. In terms of estimates, there are issues like depreciations, and your depreciation method can be different from my depreciation method. So it gives room for maneuver. All right. So basically, that is it. All right. But what you have to understand is that where a standard exists for a transaction, then the standard is the accounting policy. All right. Where there is a standard. So what you have to understand is that where a standard exists for a specific transaction, then what it means is that the policy will be the application of that standard. The application of that standard. But what if a standard doesn't exist? There's a particular transaction and a standard doesn't exist. So where no standard exists, where no standard, there is no standard for that, there is no interpretation for that, what do you do? In that case, what we're going to do is that management of the entity must apply what we call professional judgment, all right, to develop and apply a policy. Okay, so that is what will happen. So it's the onus is of management. So management must use professional judgment. This is an audit term, right? Yeah. So you use professional judgment to develop a policy. I mean, who says the useful life of a car is 4 years? In terms of making an estimate, who tells us that? Nobody. It's your own company. Management says they do a board resolution on certain things. Then they do. So you develop and you apply what? Apply a policy. Okay, so that is the key thing. But it's just that you have to make sure that in terms of developing and the application of the policy, it is very good that you refer to the conceptual framework. Because the conceptual framework we learned in our first lecture, it is the frame, all right, for the development of the standard. Okay, so you have to go back to the conceptual framework. The conceptual framework, all right, so that if there is no conceptual framework, find out are there standards dealing with similar or related issues? Okay, standards dealing with similar or related issues. All right. So you look out for that. I mean, if you still don't get anything, then it means that you can still also refer to the industry practice, and this is the most common one that has been happening. So you look at the industry's practice, and that has been what then any pronouncement made by any standard setting body. All right, so usually that is what happens, made by the standard setting body. There may not be a standard, but they might have said one or two things about it, or one or two things about it. All right, so that is your look away. But like we said, whatever standard or whatever policy that you are applying, these policies, just make sure that, like we said, make it in reference of the conceptual framework. What is going to happen is that you need to apply relevance and what? Relevance and what? Yes, faithful representation. The fundamental qualitative characteristics of financial information. All right, so there should be a faithful representation. So basically, that is a policy. Okay, when you talk about a policy, these are things you have to make sure that you have all of them set up. All right, so that it won't be just a subjective, but it is rather what a professional judgment on the development of the policy. So basically, that is what you need to do. All right. But when we talk of IAS 8, not only is it about, so IAS 8, as you look at it, you just have to be careful because you saw the breakdown. So when we talk of IAS 8, even though the concept is about accounting policy, it's about accounting policy, then accounting changes in accounting estimates, then how we deal with errors. There is one thing in there, not actually said in the title, but it's part of it. And that is the most dangerous one. We call it changing policy, changes in accounting policy. Because what you have to understand is that when it comes to the examination of this standard, at this level, nobody is going to ask you what is a accounting policy. But most of the time, where they look at is mainly about the changes and how we treat the individual. So what I'm going to do right now is we now know what a policy is and how a policy should be developed. All right. We're going to look at changing accounting policies. Then we will look at changes in accounting estimates. Then we will look at errors. All right. So that is what I'm coming to take you through now. So first of all, let's look at changes in accounting policy. All right. So now, maybe you are using one policy. You started using one policy developed by your own self. You want to now go in and do another one, use another policy. How does the standard give permission for that? Okay. So first of all, the first thing you need to understand is that before you can do a change, before a change will occur, that change is only allowed. So the change is only what? Allowed. Number one, if the change gives what we call relevance. You remember that we said that whatever accounting policy that you develop must give relevance. Number two, it must what? Be reliable. And what is reliability? Reliability these days is what we call what? The faithful representation. All right, so that is that. You can actually change it. In some other books, you hear that when it is required by the standard. All right, but I mean, come on, there is no standard. That is why you are having an accounting policy. If there is a standard, then the standard is the policy. So if you are changing it, then why say changing accounting policy is when the standards require it? Fine, it's a nice statement to make, but come on. If there is a standard, the standard is the policy. And if the standard says that you can change, then you can change. So that's why they say when it is allowed by a standard. All right. So basically that is that. All right. All right, so it is on these these two pillars that you can make a successful change. All right, so that is how it is. Okay, so now, from the accounting perspective, how do we handle this kind of thing? Of course, we will talk about how the accounting angle looks like, while we will now operate or do a recording under these changes. But when is there a change in policy? When actually can we say there is a change in policy? Now, there is a change in policy. There is a change in policy when the changes that occur is affecting basically three things. So we say that there is a change in accounting policy if there occur change in or changes in three key things. Number one is what we call recognition. Recognition. Now, when an expense is now treated as an asset, you know, when we talk about recognition criteria, our focus is on the, what do we call it? The elements of financial statement. Asset, liability, we have equity, we have income, we have expenditure. So these are the elements. So recognition is placing an item in one of these five areas. So now they're happening in situations whereby something used to be an expense, but now you are recording it as an asset. It happens. It happens. Let me give you a typical example. If you have learned IAS 38, you will see that it happens. In IAS 38, there is a recognition for research and development. Research, normally we say that you will treat it as an expense. Yeah. Then the development, when it meets the pie rate, you treat it as what? An asset. But you see, in practice, this is what actually happened. Let's say if I'm developing a software, and as I'm developing the software, I incur certain expenses. These are my choices. My choices are that, let's say I'm taking 2 years to develop this software. My chances are that the expenses that I incur in the first year as part of development of the software, I will treat it as an expense. Once you treat it as an expense, the standard in IAS 38 says that once you recognize something as an expense, you cannot recognize it again as asset in the future years. But there is another option I can take. I can decide to put all those expenses in what we call work in progress. Now that I finish the entire thing in year 2, then I combine all the amount and recognize it as what? As an asset. So the choice is there for the entity to operate with. Either expenses as and when you incur it, or put it in a WIP, then when you finish, you make it as part of the asset. So that choice you have is the issue. So, and that is a recognition choice. So if you change, let's say an entity used to treat the expenses in the early stage as expense, but then it means that they cannot treat it as part of the asset. Now, if the entity now changes the policy and say, okay, we will no longer be treating it as an asset anymore, we will be waiting so that when we finish the entire asset, then we classify all the amount as an asset, then that one too is fine. So the choice is still with the entity. All right, so basically that is that. Again, there is a change in policy when the thing affects the presentation of the item, presentation in the financial statement. So you do well know that in items in our account, like let's say depreciation sometimes can be part of cost of sales. It can also be part of administrative expense. So where do you put it? The presentation, where do you put it? So the choice in terms of where to put it, and any further change and say, okay, we used to put it at cost of sales. Now let's put it, of course, the depreciation of a building within which they are making a manufacturing seems to be part of cost of sale. But in that building, there might be administrative aspect that is used. So if you allocate it to cost, I think those of us who went through the system of cost accounting, where we have to use square meters to actually apportion these kind of depreciation, but in financial reporting, we tend to bulk everything up, either cost of sales or administrative expense. So that choice is there. So when it happens like that, then it means that change is also accounting policy. Then the last one is measurement. Measurement. All right, measurement basis. Measurement basis. Now, so therefore, measurement basis, like, let me use, in terms of measurement, when we say use the cost, all right, some people will talk about replacement cost. Others too will be using the historical cost. So it's a choice. It's a choice. In terms of valuing, what do we call it? IAS 2, what we did earlier. What is happening is that you can use FIFO for the interchangeable goods. You can use FIFO. You can also use what? The average cost, weighted average cost. So all these things are what? Policies. All right, policies. And so that is that, policies. And therefore, when we talk about changing policy, the accounting treatment says that this is what we can do. Oh, accounting treatment. What happened? You will treat it, the standard says that, first of all, check the transactional agreement, all right? Check the transactional agreement. If there is one, then you apply one, okay? But if there is no transactional agreement, in the absence of transactional agreement, what we do is that you apply the change retrospectively, all right? Without transactional agreement, change is applied retrospectively. What do we mean by retrospective? Go back and make the changes. We are not saying go back and prepare the entire financial statement again, because the financial statement has been prepared, signed, sealed, and delivered. You cannot go back and re-prepare. But what you can do is that you can go back and see the effect if the writing had been done, or if the last year's financial statement had been prepared according to the new change. All right, then you will realize that there will be an effect, obviously. So what you're going to do is that after you've done that, what you're going to do is that you adjust the opening retained earnings, all right, of the current year. All right. So adjust the opening retained earnings. All right. So that is what you're going to do. Opening retained, and that's the equity side. All right, the equity component. All right, so that is that. So if a P&L item, adjust the opening retained earnings, all right, of the current year. So how the whatever policy you are adapting now would have affected last year, and it will affect the profits. So if it affects the profits, then it means that all profit goes to the balance sheet through the retained earnings. So you come and adjust the opening retained earnings. We will look at some figures, then you see how these things are done. All right, so that is that. Then after you are done with that, it means that your comparatives are going to change. I mean, when we say comparative, the previous year's, presentation, that is how it's going to be. Now, the comparative will now be that you take the new policy and the new policy financial statement. I mean, the new policy you have used to prepare the current financial statement. You are now going to prepare the comparative with the last year's own. All right. So that is what is going to happen. Now, with this comparative, IAS 1 says that you have to present the SOFP, statement of financial position, at the reporting date. I mean, the current one, right? Reporting date. Then you prepare another SOFP at the start of the current period. So the end of the current period, the start of the current period. Then another SOFP at the start of the previous period. So that is what IAS 8 accounting policy talks about. So we're going to look at a simple example, and we will come back and we will talk about changing estimates. Then we'll talk about the errors. All right, so basically that is that. Or better still, let's just talk about the change in estimate. Then when we finish, we take the errors, then we take the questions, then we move. All right, so what is a change in estimate? Of course, what is an estimate? An estimate is just some monetary amount in the financial statement that are subject to measurement uncertainty. So that is an estimate. The monetary amounts in the financial statements that are subject to measurement uncertainty. So it's all projections. All right, so basically that is it. Example of these ones are We all know our depreciation. We know determining the fair value of an asset or liability. The net realizable value of inventory. All these things are what? Estimate. All right, so that is that. Of course, so when you look at these, the next thing that you have to talk about, like the policy, is the change in estimate. Changes in estimate. The thing is an estimate for, first of all, to be changed. So don't mess up a change in policy with an estimate. Policy is not an estimate. So that is the line, the lifeline or the thin line. All right. So that is that. So understand that change in estimate, change in accounting estimate is not a change in policy. It's not a change in policy. Please take note of this, because if you mess it up, you are wrong. All right. You are wrong. And examiners don't take kind look at these things at all. And that is what they examine. So don't treat a change in estimate. The thing is an estimate. No, know the things that are estimate in the financial statement. All right. So that you know that this is separated from a policy. All right. So that is that. Especially when we see these changes most of the time in the useful life of NCA, the useful life of our non-current asset. We see the depreciation method. Depreciation method. You see, all these things are estimates. Okay. The depreciation method is just giving us our estimate of depreciation. Warranty provisions. We have warranty provisions. You know what a warranty is. So warranty provisions. All right. So the guarantee that shop owners give to people for buying things in their shop, like Malcolm. Because when new information comes, they want to update it. So they, based on what? Updated information. So anytime they are changing those warranty provision amount they've made in the financial statement, because new information have cropped up, that is a change in estimate. The accounting treatment, therefore, is that change in estimate is applied from the current year through to the future year. All right. So we say that it is applied prospectively. Prospectively. So in the current year, affected by the change, and in what? The future period. So for example, if you read a question, they tell you that they change the useful life of the asset after revaluing it. You don't go back and say, oh, I'm going to apply the new useful life. You continue from where you are. All right. So basically that is that. We say that one is what? Prospectively. Then the last one, before we look at the computation, is the errors. And the errors, especially if you are writing financial reporting, it is tested most of the time. Whereby they say that some cash was stolen. You didn't find out in the last previous accounting year. All right. But you found out after financial statement of the last accounting period has been published, gone. You now found out. You are going to effect the change. And that change, after you found the change, you are going to now affect the equity component of the new financial statement that you are preparing. So these are things you should be very, very careful of. We will look at some of these things when we are doing the revision class, all right, ahead of us. Okay, so that is that. So errors, when we say errors, what are errors? Errors are mathematical misstatements. Omissions. All right, of the prior periods. Of course, if you made the error in the current period, you can correct it. All right. You make the errors because of what? Because of using unreliable information. All right. That is that. What you have to know is that the accounting treatment of errors is the same as that of the policy. Accounting treatment. This one too, you have to go and correct it. All right, go back. And when we say go back and correct it, like the policy, we are not saying go back and prepare a new financial statement, because the financial statement has been signed, sealed, delivered. But go back and see the effect, all right? Then come and affect your opening retained earnings or the equity component of your current financial year. All right. So what you do is that one too, you check the retrospective effect. All right, retrospective. So it's applied retrospectively. All right. So ladies and gentlemen, this is all about, of course, it's a disclosure standard. So what you need to do is that you have to disclose any material changes. Okay. So all material changes must be disclosed. All right, this is the key bit. Okay, so now let's look at how the figures work. Let's look at how the figures work. So look at this. Let's see how we can deal with this kind of. All right, so as you can see, for example, look at this. We have during the year 2011, a company discovered that certain items has been included in their inventory valued at 2.5 million. But they had in fact been sold at year end. So the thing was sold, but when they were valuing their closing stock, it was part. So this is a clear error. All right, it's an error. So it means that we need to, and they finished preparing the financial statement. It said the original figure reported in 31st December 2010 and 2011, these are the figures. Because the 2010 one has been prepared and gone, but we discovered this one in 2011. And we are told that the retained earnings as at 2010 is 11.2. And the cost of goods sold in those periods includes that 20 million in error in the opening inventory. In the opening inventory. So you have to be very, very careful. So the cost of goods in 2011. So let me show you this. When I was in senior high school, this is how we used to prepare financial statement. You see, there is sales. All right. So let's say this is 1,000. Then we will do something like cost of sales. So let me say 10,000. And let me say this one is 2020. Let me say this one is 20. We are in 2024. So let me make this one 2023. Probably this one in 2024. So our sales will be like this. And so let's say this one, two, we have something like 20,000. And then you bring cost of sales. Our cost of sales, this is how we used to do it. We have what we call opening stock. So let me say 1,000 or 10,000. Then we add purchases. Let's say 5,000. If there is carriages, we add drawings. So like if it's a sole proprietor, you check those ones. Okay, then you get like this one is like 20,000. Then we less closing stock. So let's say this side is closing stock is 15,000, meaning that you have 5,000 here as our cost of sales. When we take it here, our gross profit is what? 5,000 from this 5,000. All right, so let's say this side to our cost of sales opening stock is 15, purchases 5,000, carriages 5,000, something like that, just an estimation. So we will have here like how much? 25,000. Then let's say our closing stock is 10,000. So we will have here something like 15,000. And we will have our gross profit like 5,000. Now, assuming they tell us whether it is an error, whether it is an accounting policy change, that inside this opening stock, or most of the time, this is coming from last year, so you won't get it like that. Inside this closing stock is a 5,000 that shouldn't be there. But you see, in current times, this is how the financial statement will look like. Current times, sales will be what? 10,000. Then we go straight, less cost of sales. And that from here, you see that cost of sales is what? 5,000. So you had your profit. And same for this side too. So our sales was 20,000. Cost of sales is 15,000. Then we have 5,000. This is how we present financial statements, all right, according to IAS 1. But if they tell us that included in this, you see, included in closing stock or not cost of sales, closing stock is a 5,000 that shouldn't be there. Meaning that if it was not there, our closing stock would be what? 10,000, which means our, okay, let me say 2,000. Okay, 5,000 is quite huge. Let me say 2,000 is a 2,000 that shouldn't be there. Meaning that what should be here is not actually 15,000. It should actually be what? 13,000. If it is 13,000, then it means our cost of sales should have been what? 7,000. Are you getting it? So that is it. So now, if it should not be there, that 2,000 should not be there, which means, and what you should know is that, per what I did here, it should tell you that, you see, the closing stock of this year is the opening stock of this year. Are you getting it? So if this side should have been 13,000, which means this is it, then it means this side too should be what? Yeah, exactly my point. So it should also be 13,000. And if this side is 13,000, you realize that what then happened? We should have had here 23,000, right? And if you take this thing out, so you have 13,000, 23,000. And if you take 10,000 out, this side should be what? Like kind of 13,000, right? So that is what is happening here. That is what is happening here. So you will see that the net effect of what is happening is affecting the new year here. That is what is happening. So if this side should have been 13,000, then it means that our profit here should be somewhere, if this side becomes 7,000, then our profit here should be what? 3,000. So it means that there is a 2,000 effect we need to change. And that 2,000 effect, we can't do that to this financial year again. But good news for us, we can go and affect the retained earnings of the current year, because this, if this is our net profit also, it will be the net profit brought down for, so you have net profit brought down for 2014, and what they recorded might have been what? 5,000. So when we say adjust or affect the current year retained earnings, this is what is going to. So you bring what we call prior year adjustment. Prior year adjustment. Our profit should actually be what? 3,000. Is that not it? Because if this thing, okay, so this is 13,000 and we have 7,000. So we should have 3,000. So it means what? Adjust here 2,000 so that you have the 3,000 before you come and bring this year's on. All right, but you realize that since it's about inventory, this year's own too will change. But this year is we are doing it, so we will actually know that, oh, this thing should be what? 7,000. We will actually know. So it means that net profit, we will correct it, net profit, and we have what? 7,000. So that is how it is going to be. That's why we say that in terms of presentation, present the reporting date of the current year, then the start of the current year, then the one of the previous year. So this one, when we were doing this, where are you? Yes. Start of the current year, start of previous year, then the reporting date of the current year. All right, so that is what so you see how the effect can be. So let's go back to our question and see how we can manage it. So this is it. There you have the comparative for the years. All right, the retained earnings for this one is this, the 2010 one, which we will have to is that one is the one that is for the last year, but in the current year on, we have to go back and correct it. You see, the 2,500 that shouldn't be there. This is the effect of what is happening. We have sales. All right. We have sales. And you realize that in the 2010 one, they said that we have to take out. All right. If you take it out, your cost of sales is going to increase. Okay. It shouldn't be there like this one. If you take it out, your cost of sales is going to increase. So the 2010, you see, we have added the 25 back. So that is what you see. It is going to increase it. That is it. It shouldn't have been there. All right. So you add it back. You add it back. Then you realize that, okay, if it shouldn't have been there, then the cost of sales of the other one will also, but look at this one. The effect is this. So it means that you have to take the opening stock of this year and deduct it. You deduct it. All right, you have to take it off. Now you realize what we did here. Okay, so what we did here, you see that there is a reduction. So you see, you have to take it off the cost of sales. So you have to measure the effect very well. The thing is that for this one, is different from what we did here, should not be there. And they included it. So we had to what? Take it out. But you see, they said that it include that has been sold, 2.5 million of something that has been sold. So as you could see, what we did here, 10,200. This is the cost of sales. Be careful. That is not that inventory, because what is happening here, if that thing is not supposed to be, what they've done is that thing was sold. It should be part of revenue. And herein, what you see here, just a minute, guys. All right. So if the thing, as you see here, the cost of sales we see here, that thing is no more hanging there as a closing stock. So it means that we need to take it out of our closing stock. Now, when you do that, you see that your closing stock is actually supposed to increase. The typical example of what we did here, it will push, because if you take it out, that is what is going to happen. All right. So basically, that is that. Now, here, it means it's going to affect your opening stock, but we don't see this picture of opening stock. What we see is the cost of sales. So that is what is happening. That is what is happening. So you realize that what we did here, our closing stock increased, cost of sales increased to 7,000. And here, our cost of sales had to reduce to what? 13,000. So exactly, I think that, yeah, that's the same effect. So you see in the current year, it's just that the scenario I did here is a little different, but it's the same, because in both cases, something shouldn't be there. All right. So basically, that is what you see in here. So it means what you are going to do is that you're going to correct it. You see the net effect now. Then these things must reflect now in the opening retained earnings, like I did for you to see. If there in this situation, the opening retained earnings, we actually found that if only this is the only one that we have. But in this question, there is an opening retained earnings of what? Where is that? So last year is 11,200. That is what we have. Then we make the corrections. All right, the prior period correction. So if this is this, we get this amount, like the one we did here, and it was 5,000. All right, we do it here. Okay, the net profit, you see the correct one here. And we have 22,500, which means we have to make an adjustment of the current year own to meet the 22,500. So we make the adjustment and it becomes like that. Then we bring in what? The new profit, just as this one, the new profit. So over here, the entire thing now goes back to 10,000. So what we mean here is that adjust the last year change, the effect in the last year into, all right, the opening retained earnings. So basically, that is that. That is that. So like I always say, the manual is already there. You can contact me for more examples of these. You see, we do plenty of them. Correction. All right. So you can pick up the number if you are a FR student. You can pick up the number if you're a corporate reporting student. Wherever you are, we can get you the book. All right. So basically, that is that. So that is the most important thing you've got to understand in terms of what accounting policy. All right. So go back and make the change. So in FR, you see that most of your reportings, these things come for you to be dealing with. And you have to make the adjustment in the retained earnings of the current period. Thank you. God bless you. Have a safe evening. Bye-bye.